Hello viewers at home. You are welcome to my presentation on cost of capital. In this presentation, I'll be examining the cost of equity capital using dividend valuation model. I will as well consider how to calculate the growth rate using dividend valuation model as well as the Gone Grow model. Please subscribe to this channel to keep up with my upcoming lectures. Now, cost of capital. Cost of capital is the minimum required rate of return on the investment project that keeps the present wealth of shareholders unchanged. Cost of capital is the minimum required rate of return. The minimum required rate of return on the investment project that keeps the present wealth of shareholders unchanged. So, we have sources of finance, sources of long-term finance. We have the equity or ordinary shares. That is number one. Equity or ordinary shares. Number two, the preference shares. And the third one is debt. Sources of finance. We have equity finance or ordinary share. We have debt finance. Equity finance or debt finance. Where you have debt finance, you identify the type of debt. Identify the type of debt. Identify the type of debt. After the identification of the type of debt, you calculate the cost of each type of debt. Calculate the cost of each type of debt. And if it is equity, then you calculate the cost of equity. If it is equity, you calculate the cost of equity. Then, with the cost of equity you have calculated and the cost of debt you have calculated, you use everything together to calculate the weighted average cost of capital. Using all costs together, you calculate the weighted average cost of capital. Using all costs together, calculate the weighted average cost of capital. That is for that. So now, I want to lay emphasis on the calculation of the cost of equity. Cost of equity capital. So that is the one I want to consider now. Cost of equity. What do we mean by cost of equity? Cost of equity is the rate of returns. The rate of returns the investor expects to achieve on their shares. Cost of equity is the rate of returns. The rate of returns the investors expect to achieve on their shares. The rate of returns the investors expect to achieve on their shares is said to be the cost of equity. There are three methods of estimating or calculating the cost of equity. There are three methods of calculating the cost of equity. Number one method is methods of calculating the cost of equity. Number one is dividend valuation model. Dividend valuation model. Dividend valuation model. The second method is the capital asset pricing model. Capital asset pricing model. Capital asset pricing model. And the third one is Modigliani and Miller proposition 2. Proposition 2. These are the three methods of calculating the cost of equity. The first method of calculating the cost of equity is the dividend valuation model. The second method is the capital asset pricing model. And the third one is M&M proposition 2. Modigliani and Miller proposition 2. I want to discuss now. I want to start with the cost of equity using dividend valuation model. Dividend valuation model. You want to compare dividend with the value of the business. You want to compare dividend to the value. The value is the market value. So the cost of equity is the dividend over the market value of equity times 100. Where D is current dividend. Current dividend. Current dividend. And MV, market value of equity. And the market value to consider must be X div, that is S div, S dividend. The full form is S dividend. You can abbreviate it as S div market value. KE stands for the cost of equity. KE stands for the cost of equity. KE is cost of equity. This formula will be used where there are no growth in dividend. No growth in dividend. That is where dividend is constant over the periods. Dividend paid in year 1 is what will be paid in year 2. Same amount will be paid in year 3 and in that order. So no growth in dividend. Doesn't change. So same amount will be paid as dividend every year. That is cost of equity, where there are no growth in dividend. Don't forget, I've told you that the market value to consider must be X div market value. That is, it must be X dividend. X dividend means the share price must exclude dividends that will be paid in near future. It means the share price must exclude the dividends that will be paid in near future. How will you know that the market value you are given is X div? It is X div where the dividend has been paid up to date. Where dividend has been paid up to date, that means the market value you will be given will be X div. But where dividend, certain amount of dividend has been due but not yet paid, you know that the market value you are given is cum div. It is cum div where dividend is outstanding, where there are outstanding dividend. Market value X div now. So now when you are given cum div, I've told you that certain amount of dividend has been due but not yet paid. So where you are given cum div. Now to convert the cum div to X div now, you have market value of equity cum div minus outstanding dividend. Market value cum div minus outstanding dividend. That is X. That will give you the XD market value. Example 1. Example 1. A company has paid a dividend of 30 cents. If this question is given in Nigeria context, wherever you see cent, the letter C there, it will be kobo in Nigeria. In Nigeria context, it will be kobo. So you may change your cent to kobo. This question is obtained from ACCA Kaplan Study Test Financial Management and Advanced Financial Management. A company has paid a dividend of 30 cents for many years. The company expects to continue paying dividends at this level in the future. The company's current share price is $1.50. Calculate the cost of equity. We were told a company has paid a dividend. So since dividend has been paid, that means no outstanding dividend. That in that case, the market value you are given is X div. Since dividend has been paid, the market value, it is X div. But where dividend has not been paid, then that means the market value is cum div. So this one is X div because dividend has been paid. So now dividend is 30 cents. 30 cents. So our dividend is 30 cents. The market value of equity is $1.50. You may convert it to cent. To convert it to cent, you multiply by 100. If you multiply by 100, it will be 150 cents. So we said cost of equity, we said it is dividend over the market value of equity times 100. Our dividend is 30 cents and the market value is 150 cents times 100. Therefore, the cost of equity will be 20%. 20%. Alternatively, convert the 30 cents to dollar. So dividend will be, if you have 30, if you convert it to dollar, you have 30 divided by 100. That will give you 0.3 cent dollar. 0.3 dollar. So I are given the market value to be $1.50. So they are both in dollar. But where this is in cent, the market value must also be in cent. Where this is in kobo in Nigeria context, the market value must be in kobo. And where this is in naira, just like this, the market value must be in naira. So now the formula remains as cost of equity equal to dividend over market value of equity times 100 over 1. So the dividend is 0.3 divided by the market value to be 1.5 times 100. Therefore, cost of equity will be 20%. That is example 1. So where there are no growth in dividend. So the next one I'm going to consider is where there are growth in dividend. Where there are growth in dividend, that is the next one I'm about to consider now. So where there are growth in dividend. So example 2. DICO is about to pay a dividend of 15 cents. About to pay, that means DICO hasn't paid that dividend. Since DICO hasn't paid it, that means DICO is having an outstanding dividend. There is an outstanding dividend. So I've told you that where there are outstanding dividend, then the market value is cum div. Then you need to convert it to X div market value. So cost of equity with growth, that is where dividend doesn't remain constant. Dividend growth where there are dividend growth rate. So cost of equity will be DO into 1 plus the growth rate over the market value of equity plus the growth multiplied by 100 over 1. So DO is the current dividend. G is the growth rate. Market value, I've told you that your market value must be X div market value. So, and K still remain as cost of equity. You were told DCO is about to pay a dividend of 15 cents. That means DCO is having an outstanding dividend. So in that case, solution to the example 2. So dividend DO is 15 cents. 15 cents. So shareholder expect a dividend to grow at 6% per annum. That is the growth rate in dividend. The growth rate is 6%. DCO's current share price is 1.25. That is the market value. Market value. And that is $1.25. Remember, this is in cent. And this is in dollar. I've told you that where this is in cent, then you convert this one to cent before you can use them. There will be correlation between them. But if you want to use dollar, that means you convert this one to dollar by dividing this one by 100. But to convert this one to cent, you multiply by 100. That means it will be 125 cents. But don't forget, this market value is cum div. How did I know it is cum div? You were told that DCO is about to pay a dividend. That means DCO is having an outstanding dividend. That is, DCO is having an unpaid dividend. Where there are unpaid dividend, that is, where there are an outstanding dividend, you know that the market value is cum div. So to compute the XDiv market value now, XDiv now, that will be 125 cents minus the dividend of 15 cents. That will be 110 cents. So the cost of equity now, our dividend is, I told that cost of equity is DO into 1 plus G over the market value of equity plus the growth rate. That is the cost of equity. That is the formula. Now, substituting into the formula, our DO is 15 cents. 15 cents into 1 plus G. Our G is 0.06. That is 6%. Convert it to decimal by dividing by 100 over the market value. The market value is 110 cents plus G. Our G, the growth rate. The growth rate is 6%, which is 0.06. So everything you now multiply by 100. So now, if you have 1 plus 0.06, it will be 1.06. 1.06 times 15, it will give us 15.9 divided by 10. Divided by 110, I mean. That will give us 0.1445 plus 0.06. Then you now multiply everything by 100. So when you add the 0.06, then you have 0.2045. Now multiply by 100. So you have 20.5%. 20.5%. That is the cost of equity with growth. That is for that. The next thing I'm going to consider is how to estimate the growth rate. Estimating the growth rate. That is the next thing I'm going to consider now. Estimating the growth rate. Estimating the growth rate. There are two ways or methods of estimating the growth rate. The first method is the dividend valuation model, and the second one is the Gordon growth. Dividend valuation and the Gordon growth rate. Those are the two methods of estimating the growth rate. I want to start with growth rate using dividend valuation model. Using dividend valuation model. Now, growth rate, the formula is nth root of latest dividend over base dividend minus 1. This formula is used where the current and the base dividend and the latest dividend are given. Where it is used where the latest and the current dividends are given. Used where the latest and the current dividends are given. It is then that you apply this formula. Then another one is this. Growth rate equals to n minus 1th root of the latest dividend over the base dividend minus 1. N minus 1th root of the latest dividend minus base dividend minus 1. This formula is used where dividend is given year by year. Where dividend is given year by year. Then you use the second formula. Now, example. A company currently pays a dividend of 32 cents 5 years ago. The company currently paid a dividend of 32 cents 5 years ago. The dividend was 20 cents. A company currently pays a dividend of 32 cents. That is what the company is currently paying. 5 years ago, the dividend was 20 cents. Estimate the annual growth rate in dividend. In this formula, LD stands for latest dividend and BD stands for base dividend. LD, latest dividend. BD, base dividend. N represents number of years data provided. Number of years data provided or numbers of growth. That is the definitions of the variables. Now, if you look at this question, a company currently pays a dividend of 32 cents. That is the current dividend or latest dividend. 5 years ago, the dividend was 20 cents. That is the base dividend. Estimate the annual growth rate. Now, the question now is, which of the two formula above should be used? Should it be this? I've told you that this one can only be used where dividends are given year by year. That means dividend for year 1, year 2, year 3, year 4, year 5. Where it is given, that is when this can be used. But now you're only given the current year dividend and the base year dividend. That means it is this formula that is appropriate. It is this formula that is appropriate because you are only given the current year dividend and the base year dividend. Now, on the basis of the question, now let's solve. Example 1, solution. A company currently pays a dividend of 32 cents. This 32 cents represents the latest dividend. LD is 32 cents. 5 years ago, that means number of period of year is 5. The dividend was 20 cents. That means the base dividend is 20 cents. You have to estimate the annual growth rate in dividend. So substituting into the formula, growth rate equals to N is 5. The latest dividend is 32. And the base dividend is 20 minus 1. 32 divided by 20, and that will give us 1.6. So we have the fifth root of 1.6 minus 1. What is the fifth root of 1.6? You press the second function, so, and then 1.6. The fifth root of 1.6 is 1.09856 minus 1. Minus 1, then you have 0.09856. So you can convert it to percentage. G will be, so if you convert it to percentage, you multiply by 100. You multiply by 100. So times 100, our growth rate is 9.9% or 10%, whichever one you prefer. So that is the growth rate in dividend. So which is 9.9%. So that is for that. We want to take another work example. Example 2. So we want to take another example. Example 2. Example 2. You were told that a company has paid the following dividend per share over the last 5 years. The company has paid the following dividend per share over the last 5 years. 20 year 0, 10.0 cents was paid. 20 Y1, 11.0 cents was paid as dividend. 20 Y2, 12.5 cents was paid. 20 Y3, 13.6 cents was paid as dividend. 20 Y4, we have 14.5 cents was paid. You have to calculate the average annual historical growth rate. You want to calculate the growth rate. If you look at this question, this is a bit different from the first one. Dividend is given year by year. The current year, which is 20Y4, that is the current one. While that of 20Y0 is the base one. How many years are involved? 1, 2, 3, 4, 5. So now the formula to use now. The growth rate equals to N minus 1 into latest dividend over base dividend minus 1. Why are we using this formula? Because the dividend was given year by year. You are not only given dividend for the current and the latest year alone. You are given dividend year by year for all those years in questions. So now, the current dividend is the latest dividend is 14.5 cents. So latest dividend 14.5 cents. The base dividend is 10.0 cents. 10.0 cents. and n is 5. N 1, 2, 3, 4, 5. 5 years. 1, 2, 3, 4, 5. 5 years. That's how I got n to be 5. So substituting into the above formula, you have G equals to 5 minus 1. N is 5 minus 1. That is 5 minus 1 into latest dividend, which is 14.5, over base dividend, which is 10, minus 1. This will now become the fourth root. 5 minus 1 is 4. That is fourth root of 1.45 minus 1. 14.5 divided by 10. That is how I got 1.45. You press the fourth root, 4, shift, then the fourth root of 1.45. Fourth root of 1.45 is 1.0973 minus 1. When you subtract 1, you get 0.097. You can convert it to percentage by multiply by 100. So times 100, then you have 9.7%. That is the growth rate in dividend. So please subscribe to this channel to keep up with my upcoming lectures. Subscribe to keep up with my upcoming lectures. I want to examine the Gordon growth now. Gordon growth model. Gordon growth model. Gordon growth model. According to Gordon, the growth rate is R times B. R times B. What does G stands for? G is growth rate. R is return on investment. Return on investment. Or your accounting rate of returns. Return on investment. YB is retention rate. Retention rate, or proportion of earning retained, or proportion of earning retained. How much do we retain as earnings after the payment of dividend? To get the amount retained, you have your profit after tax minus dividend paid over your profit after tax. So that will give you the retention rate. From your profit, part of it were paid as dividend. The remaining ones will be retained. So that is B, retention rate. So we want to take question as example. We want to take a question as example. So example 3. A company is about to pay an ordinary dividend of 16 cents. About to pay. That means they have not paid it. So since dividend have not been paid, that means there is an outstanding dividend. In that case, the market value will be cum div. So you need to convert the market value to S div by subtracting the dividend from the cum div market value. A share, okay, a dividend of 16 cents a share. The share price is 200 cents. The accounting rate of return on equity is 12.5%, and 20% of earnings are paid out as dividend. This is dividend payout ratio. If 20% is paid out, that means the remaining 80% will be retained. Our retention rate now. Solution: how much of earning were retained. From 100, 20% were paid. Then that means the remaining 80% will be retained. R, you are given the accounting rate of return on equity is 12.5%. So retention rate is return on investment is 12.5%. In that case, the growth rate will be R times B in accordance with Gordon. So our R is 12.5% times B, which is 80%. So the growth rate now will be 12.5% by 80%. Then we have 10%. Therefore, the growth rate is 10%. You have got the growth rate. Now you want to estimate, you have to calculate the cost of equity. You want to calculate the cost of equity. So now, since there are growth rate, the cost of equity, we said DO into 1 plus G over market value of equity plus the growth. That is the formula. So that is the formula for estimating the cost of equity where there are growth in dividend. Now, how much is the dividend? Our DO. We were told a company is about to pay an ordinary dividend of 16 cents. The dividend is 16 cents. Then the growth rate has been calculated and we got 10%. 10%. The market value. We were told a company is about to pay. I've told you that where there is an outstanding dividend, about to pay an ordinary dividend, that means dividend have not been paid. Dividend of 16 cents hasn't been paid. That means the market value is cum. So the share price is 200 cents. So that means the 200 cents is the cumulative market value. So you have to subtract the dividend from it in order to make it X div market value. 200 minus 16, then we have 184 cents. That is the X div market value. Because we said the 200 is cum div because the dividend is about to be paid. That dividend has not been paid. So in that case now, substituting into the formula, you substitute into the formula, we say cost of equity equal to DO into 1 plus G over the market value plus growth. You can multiply by 100 to convert it to percentage. Our DO is 16 into 1 plus G. Our G is 10%, 0.1 over market value 184 plus G. Our G is 10%, which is 0.1. 10% is 0.1. 10 divided by 100 is 0.1. So now we have 16 times 1 plus 0.1 will be 1.1 times 16. That will be 17.6. Divided by 184, that will be 0.095. We have 0.09565 plus 0.1 times 100 times 100. So plus 0.1. Then you have 0.19565 times 100. So when you convert it to percentage now, times 100, cost of equity is approximately equal to 19.6%. Please subscribe to keep up with my upcoming lecture. In my next lecture, I will consider the cost of preference share, where we examine the cost of redeemable preference shares and the cost of irredeemable preference shares. Please subscribe.